Hello and welcome to episode 370 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leeks. Damien, how are you doing?
I'm really good, Andy. I've just been spending time trawling through the recent reviews on the podcast, and they always give me a buzz. So thank you to the people who've sent them in, and Andy's going to read a few of those out in a moment. But if you've not reviewed the podcast, or even if you have done it in the past, you can do it again. Please leave us a review on whatever app that you use, whether it's Spotify, Apple Podcasts. I even noticed you can listen to our show on Audible this week, Andy, which is a new thing to me. But please do leave a review. It really helps us on all the platforms that we are listed on to be pushed up those charts and increase the reach of the podcast. So thank you for that. And a bit of admin, actually, Andy, before you read out those reviews. There won't be a podcast next week. So that's because it's a shortened week with the Jubilee. Andy is away as well, but we will be back the week after that. And also that week we will have a Damien's Market update as well. So we're doing that monthly, if you remember, and we had lots of good feedback and questions and comments on the YouTube video relating to that show. And I've responded to all of those, and some of them with some quite in-depth answers as well. So that will be back at the start of June.
Okay, so let's rattle off some podcast reviews then and give you listeners the chance to win a Money to the Masses mug. If any of these are you, then prove it by emailing in to lauren@moneytothemasses.com and we'll ensure your mug is sent out. Okay, so the first one is from Normal. Wow, podcast has been amazing for years, but somehow manages to get better and better. The last episode was packed with information for everyone on how to manage inflation and the squeeze on finances. The next one is from Nath F22. Good info and very worthwhile listening. Gives good advice and worth listening to. Short and sweet. I love that though. 5 stars. Stephanie SD is next. I love the Money to the Masses podcast because it's always current, straight to the point and relevant with real financial examples. Something that many podcasters shy away from. It's a weekly must for me. Thank you. John Thornley next. A really well pitched, timely and topical show who know how to talk to its audience. Always a great listen. And we'll finish off with Shrimpy. Damien and Andy create an essential foundation for everyone's personal financial knowledge, covering the basics clearly and extending to details of all aspects of the financial world. My thanks to the whole team for aiding my understanding and keeping me updated on all aspects of my own financial health.
So you can see why I was happy reading all those reviews. And just to throw it out there, I am penciling in a podcast meetup towards the start of July. So we'll have more details in the coming weeks when we sort of firm it up. But the team will be going out for a drink, and everybody who listens to the show or who follows us on socials or whatever, they're all welcome to come and join us. So Andy, I will tell you now what's on this week's podcast so we can get the show underway. There's 2 investing pieces this week, so a bit unusual. I'm going to do a piece on Bob Farrell's 10 investing rules. So there is a list almost known as the 10 commandments that are passed around Wall Street that were created by an investment guru that had a career on Wall Street spanning 45 years. And I'll run through all the rules and explain what they are, because they are meant to help you navigate through any type of market condition. I'll then jump onto fractional shares. What are they? And more importantly, which platforms allow you to buy them? And that will be of particular interest to people who are wanting to get into trading shares with small amounts of money. And finally, I'm going to tell you a story. So this week, I was very creative, Andy. I wrote a story on Instagram that proved incredibly popular about a magic box. And I'm going to tell that story for podcast listeners because it's got a very important message in it, which makes anybody richer who hears it.
Okay, so let's get the podcast going then. Damien, you're going to be talking about 10 investing rules.
Yeah, so Bob Farrell was a Wall Street strategist known for predicting changes in stock market direction. And he is currently 90 years old and is actually retired in Florida. Now, he had a career that spanned 45 years on Wall Street, and some of that, 25 years of that, he was the chief stock market analyst at Merrill Lynch. And because he had such a long and fruitful career, he has seen every bull and bear market since 1957 when he joined Merrill Lynch. Now, in the late 1990s, he produced an iconic 10 market rules to remember. And as I mentioned in the intro, they were passed around Wall Street. They almost are the 10 commandments of investing that seem to get pulled up every now and then to help you navigate investing in the stock market, particularly when everybody else around you seems to be losing their heads when it comes to investing. So I'm going to run through the 10 rules, and then I'm going to relate that to where we are in the current market. So Bob Farrell's rules start with number 1, markets tend to return to mean over time. And that means that markets don't go in one direction forever, and they tend to come back to their longer term trend. So whether that's going to be some kind of moving average, or if you're looking at the valuation in terms of price to earnings, maybe, or how expensive stocks are, they tend to come back to their mean over time. And that also means if they dip below their long-term average, they tend to come back up to that mean. So if you get overly euphoric or pessimistic market conditions, that tends to cloud people's judgment. And so we see that a lot now. So we've seen equity markets rally almost in one direction ever since the financial crisis. And perhaps we're seeing some of that unravel at the moment, where we're seeing a significant pullback in equity markets. So that rule then leads on to number 2, which is excesses in one direction will lead to an opposite excess in the other direction. Now, a way to think of that is like a rubber band of some kind, that when markets become stretched, so you might have a bubble of some kind that may inflate itself almost beyond the point that seems sustainable. Markets can carry on being irrational for a very long period of time, longer than you probably expect. And then when that then reverts to mean, it doesn't just drop to mean, it can end up going way back in the opposite direction. So if you think about a market crash, go back to early 2020 when we had the COVID pandemic, and you saw stock markets there at the point where they were at or near all-time highs. And when the pandemic hit, we had a massive sell-off in equity markets. If you look at the charts on your phone, you see that it was very extreme and very quick, and then it bounced back the other way. So you tend to go from oversold to overbought and vice versa. The third rule is there are no new eras. Excesses are never permanent. So that kind of relates to rules number 1 and number 2, but it's this idea that this time is different. So you might see that in newspaper articles, quotes from people like analysts, where they will talk about a particular situation in markets and say, yeah, history isn't relevant in teaching us anything about now because this time is different. And you can go back and just look at recent history. It's littered with them in terms of technology stocks, why they could keep going higher and higher, even based on really stretched valuations. So they're really expensive for the earnings they were producing. People were saying, yeah, but this is different. This is not like the dot-com bubble that burst because of some new innovation, or we're in a new world order. And Bob Farrell, who wrote these, like I say, back in the 1990s, suggests that that isn't true, that you never have a new era of any kind. And so you end up getting these excesses, but they aren't permanent, and people get sucked in, and then we get that reversion back to mean. Number 4, I've already touched upon it actually, and that's that exponential rapidly rising or falling markets usually go further than you think, but they do not correct by going sideways. So what Farrell means by that is that when you get that exponential rapidly rising or falling market that becomes overstretched, you do inevitably get that pullback, as he states in his earlier rules. But I've seen a lot of people say that markets can just correct by keep bouncing along and trading in a sideways range, and so they will correct over time. So let's say a stock rallies very quickly, and if you go back to a previous podcast, I talked about RSI, so the relative strength index, which can tell you about the level of a stock being overbought or oversold. So basically an indication of whether there's going to be a change in direction of the price moves, because maybe people have got too euphoric on that stock or too pessimistic and they've been selling en masse. There is an idea that over time, if people stop buying to excess or selling to excess, and the stock price just goes sideways for a period, then that relative strength index can start to settle down, and you actually get to a period where the market bases for a while and everything else sort of catches up with it. So we have that period of calm. And Farrell says that isn't the case, and you do see a reversion to mean. Now, rule number 5 says the public buys the most at the top and the least at the bottom, which leads nicely onto rule number 6, which is fear and greed are stronger than long-term resolve. So he's saying that people are emotional investors, and we are. It's one of the flaws of being human, which why as a collective humans are poor at investing. And that's because when we get scared, we're likely to make knee-jerk reactions and sell during market crashes rather than perhaps buying or holding firm. But equally, when the market is rallying strongly, we have that FOMO, that fear of missing out, and we'll pile in and we'll buy at the top, and the market then crashes, and then people start to sell and they've actually just crystallized a loss. That we have seen repeat over and over again, and we see it in all kinds of markets, not just stock markets. Just have a look at what's been going in crypto markets in the last few months, and you'll see that playing out over and over again. Number 7 is markets are strongest when they are broad and weakest when they are narrow, and that is about breadth, and I've talked about that on the podcast. If you think about a stock market, the stock market is made up of lots of individual companies' stocks. But if you look at something like the S&P 500, then probably around about 20% of the returns on that are driven by about 5 big names, and they're all tech names. And so you end up getting a concentration of leadership, and that means that the direction of that index is determined largely by this overweight or over allocation to a very limited number of stocks. We've seen it in the past. In fact, we saw it back in the dot-com bubble. We saw it going back even further than that when we've had significant changes in direction on stock markets. And so right now we've had that with the big technology stocks in the US, because don't forget that depending on the index and how it's calculated, the S&P 500 is actually weighted. So the bigger a company's market cap becomes, the bigger its weighting in the S&P 500, so its influence gets bigger and bigger. What we really want to see as investors is a market where you're seeing lots of stocks hitting new highs. That shows that you've got strength and depth in the market, because what we tend to see in weak markets is that the index might be going up, but actually beneath the surface, lots of, or the majority of stocks can actually be falling, but the big ones drown that out when you look at the index level, and so you don't really get a true reflection. That's a weak market, and we've seen that in recent history, and right now we're seeing some of that unwind a bit, because we're seeing the large cap stocks falling and being out of favor so far in 2022. Rule number 8 is that bear markets have 3 stages: a sharp down, a reflexive rebound, and then a drawn out fundamental downtrend. So it drops, you get a rebound which tends to suck people in as they fear missing out on this new rally, and then we get a long drawn out downtrend. And you can see that again if you go back to the dot-com bubble. That downtrend lasted for a significant period of time, really a couple of years, and actually you could argue that stock markets didn't really recover for the best part of a decade. Number 9 I like, when all the experts and forecasts agree something else is going to happen. I think that's particularly relevant even now when you look at what people are saying about the direction of bond yields, the direction of inflation and economic growth. It seems to be a consensus that everything is going in one direction, and that tends to be when something else is happening. You'll hear me often talk about that on the market updates that I do. And number 10, which is a bit of a throwaway one really, it's bull markets are more fun than bear markets, and that's because it's very hard to make money in a bear market. So those are the 10 rules, and there is a suggestion, because these were made back in the 1990s. I've seen people say that, well, once we had QE, which is obviously quantitative easing, or you could call it money printing by the central banks after the financial crisis, and after COVID as well, the pandemic, when we saw the economies around the world slump, and obviously low interest rates, that obviously fueled markets artificially, and we've pretty much been going up ever since, with periodic pullbacks where investors then buy the dips and the market rallies again as normally central banks step in. And so people have suggested that these rules no longer are relevant. And of course, ironically, if you go back to rule number 3, which says there are no new eras, i.e. this time isn't different. What you are saying, if you think QE has changed everything, is that this time is actually different. So Farrell's rules, like any other list of rules, will always be broken, and there are always seemingly exceptions. But what is interesting about that observation about whether central banks have obviously broken markets and whether these rules are even relevant is that we are now in 2022 where central banks are starting to pull away and tighten monetary policy. And so that is the problem that has started to unnerve markets. And it's one of the reasons why we've seen bond yields shoot up. And obviously we've had inflation and central banks are going to be tightening. And we've seen stock markets slump because obviously they're losing the support of central banks around the world, particularly in America. And so you can argue that even if you believed that central bank interventions have meant that these rules are less relevant than they have been over the last few decades, maybe in 2022 they are becoming once again relevant. And if you go through that list, you are seeing some of those things play out, which is just an interesting aside, if nothing else. And as a list, I think it's quite good for investors to take on board those lessons from obviously decades in investing that Bob Farrell has, just to ensure that they are being a bit rational in their investment decisions. But what is interesting, I want to finish on, is that Bob Farrell may be 90, but he has passed comment recently on the market as it currently is. And he obviously still firmly believes in his 10 rules. And talking in the last couple of months, he has said, yes, we are in a bear market. And that's because we have seen the narrowing of leadership, again, which is one of his rules. And that means the growth stocks, so particularly those technology stocks, falling out of favour, which was a sign of a weak underlying market. And now we've seen that capitulate and we've seen it fall. He believes that the market could ultimately fall 30%. So if you look at the S&P 500, he's suggesting we could go as low as 3,460 on that. Now, to give you some context, we have just about entered a bear market on the S&P 500, but it would suggest that the S&P 500, if Bob is right, is going to fall another 12.5% from here. But the other thing he was very clear on is that rule number 3 about there being no new eras will pan out in the coming months and even years. Since the financial crisis, the interventions of central banks have driven markets in one direction almost exponentially. And that has been fantastic for people who are index investors, so people who have bought passive trackers that have followed the market higher. And he now thinks that that era is coming to a close. And in the next 10 years, say, equity returns at an index level are going to be underwhelming. And actually, it's now the time of active managers who can pick areas of the market in which to invest as we see things revert to mean. So that might be, for example, energy stocks in an environment like this. Of course, he would say that having come from an active management background, but I thought it was a very good list of 10 things to remember. And if it's good enough for Wall Street, then it's good enough for us.
Okay, moving on then. Damien, you're going to explain fractional shares, what they are and where you can get them from.
Yeah, so this is particularly interesting in the world where people are engaging more with buying and selling shares, whether it's just they want to own shares in a company that they know. So they may well have a diversified portfolio of funds, but they might want to invest some money in something, say, like Apple, for example. Now, that's up to individuals, what they want to do. I'm not here to tell people what to do and what not to do. I just advise them on the risks of not diversifying their money and what are the best ways to invest over the long term. But we've seen a lot of platforms and a lot of online services and apps that are now getting into the investing space. So it could even be things like Plum, for example, which would have started life more as a budgeting app, which is now morphing into allowing people to buy shares, so start trading in shares. And this really has come about because of what happened in the aftermath of the pandemic. We saw a huge shift in the trends for UK investors. As a group, they became much more interested in buying and selling shares individually, so share trading. And the age of people doing it also got younger. And partly that is down to social media. But this is a direction of travel that we're heading in. And as I said, there are more services out there offering fractional shares, but what are they? And to explain that, I want to give an example. So round about now, Amazon is trading at about $2,200 per share. It was something like that the last time I checked. And if you wanted to invest in Amazon and you wanted to own a share and you went onto a typical platform, you would have to stump up that amount of money for one share. And that puts them out of the reach of ordinary investors who might want to invest their money into something like Amazon. So the way they would be able to do it is they might invest their money in a fund that might invest some of its money, let's say 5% in Amazon. But that's not the same. If you really wanted to own Amazon, you would want to be able to buy the shares yourself. Now, a fractional share is simply a portion of a share. So it's not an entire share, it's less than one share. So fractional shares exist and they allow you to buy shares in companies that may otherwise be too expensive, like the example I just gave on Amazon. Now, they're not traded on the open market, but you can buy them through online trading platforms, but not all platforms offer fractional shares. So how are they created, first of all? Now, what is interesting, people have heard of something called a stock split, which is very different to a fractional share, even though that might sound like something that would be quite similar. A stock split is where a company decides to split its existing shares into multiple new shares, so thereby increasing the number of shares in existence. So this has the effect of lowering the value of individual shares. So let's say that a company wanted to do a 10-to-1 stock split. If you owned one share in that company and it was worth £100, then you would end up with 10 shares worth £10 each following the stock split. So the total value of the shares was the same, but you'd have 10 individual shares. And it means that anybody wishing to invest at that point in that company would only have to pay £10 per share rather than £100 per share. And so you've seen these big companies, these big tech names, do stock splits so ordinary investors can access their shares. And it's normally quite positive for their share price, at least for a period of time. But if a company decides for some reason to do a 3-to-2 stock split, so you would get 3 shares for every 2 that you hold, if an investor owned 1 share, then they would end up with 1.5 shares, resulting in the creation of this fractional share. So that is where they come from. And the value is just whatever the fraction is, but of the current share price. So going back to my example, if you had a share that was worth £10 and now you had a fractional share that was a half a share, then that fractional share would be valued at £5. And so you still take on investment risk, just like you would with a normal share. You still get dividends, obviously paid in the proportion of the size of the share. So let's say that the dividend announcement for a company was £10 per share. If you owned half a share, then you'd only receive a £5 dividend. And so fractional shares have become very attractive to investors who want to start trading with small amounts of money. You might only have, say, £10 and you want to start to be able to invest in a range of different names out there. But the problem is that not every platform offers fractional shares if you wanted to start to get involved in buying and selling shares on a very small amount of money. And so we did a whole bit of analysis, and we'll share the table which highlights which platforms do and don't offer fractional shares in the article that relates to this particular episode on the Money to the Masses website. So go onto the website, search for episode 317. You'll find an image in the notes of this episode which tells you everything you need to know. But just to be clear, I'm going to run through the platforms very quickly. The platforms that do offer fractional shares are eToro, Free Trade, Plum, Revolut, Trading 212 and Wombat. The ones that don't are Fidelity, Finaco Bank, Hargreaves Lansdown, Interactive Investor and Plus 500. Now, the other thing you have to bear in mind that there are charges. I'm not going to run through all the charges on all the platforms because I'd be here all day, but there are different minimum investment amounts as well. So some platforms, for example, Free Trade, allow you to invest from as little as £2, whereas eToro, you need to invest at least $10. So look at the table that will be in the show notes and you will see who offers them, and we'll link to an article that summarizes all of this as well in the show notes. And there are pros and cons to fractional shares. For example, you can invest small amounts and you might be able to use them to diversify a portfolio of shares. but the cons are that not all shares are available and they can work out expensive if the platform charges for trades, which is why you need to check that. But I thought it was worth pointing out that for those people who are interested in perhaps dabbling in shares, then there are ways you can do that with small amounts of money. But the usual caveats do apply about not putting all your eggs in one basket and managing investment risk and not investing money that you can't afford to.
And to close out the podcast this week, Damon, you're going to be sharing a story, something that you shared on Instagram stories this week, funnily enough, and it was very popular. And it was about a magic box. Tell us more.
Yeah, the story was about a magic box, and the sort of premise of it was that this is a true story that would make anybody richer who hears it. So a father and son were having dinner when the son complained to his father about how hard he was working. And he explained to his father about how he hated his job and he wished he was wealthy so that he could give up work. And then he started to ask his father, well, how come he'd never seen his dad work? And why was he so wealthy? What was the big secret? Now, the father went on to explain that a long time ago that someone had told him about the existence of a magic box. And it was said, according to the stories, that if you put money into this box and closed the lid, when you opened it, your money would have doubled. And not only that, if you left money in the box, it would continue to multiply. Now, this obviously confused the son somewhat, who then asked his father, are you suggesting that you've got a magic box? And of course, the father then went on to explain how when he heard this story originally, he didn't believe it either, but he spent a long time hunting for this magic box. And eventually he discovered that the story was true. And he found the magic box and ever since had been using it to grow wealthier, which is why he no longer needed to work and he could do as he pleased. So the conversation went quiet for a bit, and then the son turned to his father and said, well, okay, assuming that he was telling the truth, could he see this magic box? And the father then explained, well, yeah, you can. I'm prepared to show it to you, but it's under my bed. And if you go and get it, I will show you this magic box. So the son went off and then eventually came back with a big dusty cardboard box in his hands, and he put it on the table. The father then explained to the son that the box had indeed made him a very wealthy man, but he'd also discovered that the box's magic didn't work for everyone and only for those people who had the patience and persistence to learn how to make the box work. So the son was obviously keen to learn all about this box and how it would work, and said he would listen and learn from his father. So the father then said to the son, okay, I'm going to teach you to be as wealthy as me. Go ahead and you can open the box. The son opened the box, and to his surprise, it was full of what looked like bank statements. And so the son looked up confused. Now, the father went on to explain that everything he told his son up until that point was true, except for the fact that the box wasn't magic. But he emphasized that the box would indeed double your money because that's what it does by law. But the box actually represented his pension, and the statements contained in the box were actually pension statements telling him how much was in his pension. The father then said to his son, look, if I'd have told you at the start that I was talking about my pension, then you wouldn't have listened to a word that I'd said. But now I want to explain to you how the doubling actually works. And he started to explain that under auto-enrollment, pension rules say that if you pay 4% of your earnings, then your employer has to pay 3% and the government will pay that 1% in tax relief. So that is doubling your 4% to 8%. So doubling your money that you put into the magic box as soon as you pay it in. He also explained that some employers will indeed pay even more than the 3% that they're obliged to by law, plus how the value of the magic box, i.e. the pension, would increase in value over time, and all that increase would be tax-free. Now, the real truth was that he explained to his son that anybody could have a magic box if they had the money to put into it, the patience and the persistence to stay the course. And eventually they could retire when they wanted to and wouldn't have to work. But he left his son with one final thought. If a magic box, as he'd originally described it, had existed, then everybody would be fighting over it to own it. If you imagine your neighbour had a box that you knew that every time he put money in it, it would double, and it would potentially go up in value over time. Yes, it can go down in value, but it potentially would go up in value over time. People would be trying to break in to steal that magic box. If you said to people this magic box existed, there'd be queues of people down the street wanting to get access or own one of these magic boxes. But oddly, the magic box does already exist. As we know, pensions already exist. It's just the way that people look at them, and they haven't really realised or understand how they work and how they are effectively creating money out of thin air if you are employed. So he told his son the whole story and said, look, if you listen and learn anything from what I told you, then you'd immediately be richer tomorrow, because then you would start paying into your pension. And of course, the moral to the story is that how you look at things makes a massive difference. A pension is still the best way to save for retirement. It's because of this aspect of it that is seemingly magical, but it really isn't. It's just law, pension legislation that people should take advantage of. But if you listen to that story and you just took away from the idea that there is this potential magic box that exists, that if I start paying into it, it can ultimately multiply my money over the long term. Because don't forget, you can't access it till you're 55. So over the long term, the value of those investments will likely rise. And the beauty of it is, even if you don't pay in 1 year, the magic doesn't stop. It keeps on going. So if you can't afford to pay into a pension this year, it doesn't matter. You can come back and pay into it next year, and that magic doesn't go away. But the problem is, if you don't ever pay into it, then it's not a magic box. It's just a box that doesn't do anything. So anybody who's listened to this podcast this week who's not already paying into a pension via auto-enrollment, maybe they've opted out or they're not maximising their contributions to take advantage of match contributions from their employer, then I suggest that they think long and hard about the magic that they're missing out on.
Okay, so that's it for this week. If you want to contact Damien, you can do so in the usual way. It's damien@moneytothemasses.com. You can contact me if you've got any questions, feedback or suggestions for future shows. It's andy@moneytothemasses.com. We've got the Facebook group if you want to get involved with any discussions. And one thing you should definitely do this week, if you haven't done so already, is follow us on Instagram. Even if it's not your social media platform of choice, there is so much stuff on there that at the click of a button you can save down. You've got access to all sorts of resources and infographics that you'll find really useful. I can promise you that. So Damien, that's it. We're done for this week, aren't we?
We're done for this week, and don't forget, we're done for next week as well. We will be back in 2 weeks' time. So enjoy your mini break, Andy, and to listeners, enjoy your Jubilee weekend, and we'll see you on the other side. Until next time.
Until next time.